Hello and welcome to Moneylife News and Views. I'm Debashis Basu. In April month, the Nifty microcap index was up 21.55%, the index in 1 month. This was an unprecedented rise since the index was launched in 2022. The CNX 500 rose 10.5%. Now, in last 5 years, this was the only month when CNX 500 was up more than 5%, more than 10%. The market decline in March, thanks to the Iran war, was treated like a festival season discount sale. Retail investors kept pouring more than 28,000 crore through systematic investment plans, even as the Hormuz Strait, through which roughly 21% of global oil and gas trade passes, has remained closed since March 2nd. But something changed last week. Reality could not be ignored any further. For starters, Prime Minister Narendra Modi made an extraordinary public appeal urging Indians to curb foreign travel and avoid buying gold for 1 year. Governments do not usually ask citizens to postpone holidays or curb gold purchases unless there is a serious underlying anxiety about the balance of payments, currency stability, and foreign exchange outflows. Then, on Friday, the US 10-year Treasury yield, the benchmark that influences borrowing costs, asset valuations, and capital flows across the globe, breached 4.5%. At the close of Friday on 27 February, before the war started, the yield was just 3.95% after falling sharply that particular day. Missiles blazed over that weekend, so when the market opened on 2nd March, the yield shot up as traders started pricing in higher oil prices, disrupted supply chains, sticky inflation, and permanently higher interest rates. Through much of April, though, yields drifted sideways as headlines about possible ceasefires and back-channel diplomacy created periodic bursts of optimism. When those hopes proved false, yields started edging higher. Then came last Friday's decisive break. The 10-year Treasury yield jumped another 2.54% in a single session, breaching 4.5% after it became clear that US President Donald Trump's highly publicized China trip has produced little beyond diplomatic theater and that the Strait of Hormuz would remain effectively closed for the foreseeable future. What are the implications of this for India? To Indian investors, the sharply rising US bond yield may sound like an obscure data from some other distant financial universe. In reality, it is the gravitational constant of global finance. When it moves sharply, everything else eventually shifts around it, especially since it comes at a particularly difficult time for India. The rupee has already depreciated by more than 6% this year, making it one of Asia's weakest major currencies, as now drifting dangerously towards a psychologically important level of 100 rupees to the dollar. The rupee's weakness is not because the dollar is staging a spectacular global rampage. The dollar index remains well below its 2022 peak at 114. The rupee is weak because of India-specific reasons. Weakening currencies are like fevers, indicating a systemic illness, something wrong within. India's vulnerability has always been energy. The country imports nearly 88 to 90% of its crude oil requirements. Oil accounts for roughly a quarter of India's total import bill. For years, abundant global liquidity masked this weakness. Investors were willing to overlook trade deficits so long as macroeconomic situation remained stable. But all vulnerabilities re-emerged with surprising speed when Iran closed the Hormuz Strait. Brent crude, which averaged around $78 a barrel earlier this year, briefly crossed 120 amid fears of supply disruptions and continues trading well above $100. For India, expensive oil is a tax on the entire system. Every $10 increase in crude price widens India's current account deficit by zero point 0.3 to zero point 0.4 percentage points of gross domestic product and raises inflationary pressures across the sectors. As I mentioned in March, energy drives fertilizer costs, which drive food prices, which drive inflation, and inflation feeds back into energy through currency depreciation. This seems to be happening now, as I had suggested. In April 2026, wholesale price index leapt to 8.3%, accelerating sharply from 3.88% in March, while inflation in several categories remains in double digits. All eyes are on headline CPI inflation, which will be hit with a lag. If it goes above 6%, reaching the Reserve Bank of India's tolerance band, the upper tolerance band, while the rupee slides towards 100, policymakers will be forced to tighten liquidity again. India's growth story currently rests on a fragile balancing act: consumption, public capex spending, and domestic liquidity. Higher interest rates threaten each of these pillars simultaneously. Bond markets are beginning to sense this problem. India's 10-year government bond yield has climbed back above 7.3%, reflecting concerns over inflation, capital outflows, and higher government borrowing requirements. Bond markets are often the first place where economic reality reasserts itself. Equities usually notice later. The trouble for India is that warning lights are beginning to flash all at once. US Treasury yields above 4.5%, oil above $100, inflation above 6%, bond yields above 7, inflation possibly above 6%, which may happen in future. Bond yields above 7%, foreign outflows above 2 trillion, and a rupee inching towards 100. Each problem alone could be manageable, but together they begin to resemble the ingredients of a macroeconomic pressure cooker. If there is no resolution to the US-Iran stalemate in the next few weeks, Indian markets will have to adjust to the new emerging risks. And I must say that the adjustment will be quite rude, because all this time in the market players have assumed, the investors have assumed, that the resolution to the war is just around the corner. I think everybody has underestimated the capability of Iran to hold out on its key demands. And that's going to keep oil prices high. And all of these problems are not going to go away in a hurry. They're going to remain, and India is going to be hit among the worst. If you like this video, please do share and do subscribe to this channel. Thanks for watching.